Hello friends, welcome to AARDHA. In this video, we will see SIP versus lump sum and whether you are investing the wrong way or right way. First of all, why this matters is because SIP and lump sum are the primary ways to invest in mutual fund. Choosing the right one is critical because choosing the wrong choice will lower your returns, will increase your stress, and market timing errors will occur. Whereas choosing the right one will optimize your returns, you will have emotional comfort, and investing will be very disciplined. So basically, your investment choice between SIP and lump sum will depend on income flow, market timing ability, and investment discipline. First, let's see what SIP is and what lump sum is. SIP is systematic investment plan. How does it work? Invest small fixed amounts regularly, monthly or quarterly. So this is best for salaried individuals because they get salaries month on month, right? So also, it is useful to build habit and regular income earners. Whereas lump sum is one-time investment. Invest large amount at once. This is best for one-time surplus. If you have surplus amount, this is best. Bonus or inheritance amount you can invest in lump sum. Also, this is good for experienced investors because here timing the market is necessary. So don't blindly invest lump sum amount whenever you have the money. You should at least check few parameters which we'll be learning in the further videos. Now let's see complete comparison. Investment style in SIP is regular and disciplined. In lump sum, it is one time. It is sensitive to market behavior. Market timing. In SIP, low risk. It is low risk as you are averaging the cost here. But in lump sum, it is high risk. Depends on entry. Your returns depends on your entry. Volatility impact. Spread out risk over time. Here, SIP will reduce the volatility, whereas in lump sum, full amount is exposed immediately. Flexibility in SIP is you can start whenever you want, you can stop it, you can pause it, you can top up it. Whereas lump sum, you are committing the whole amount at once. Returns in SIP low in strong bull markets, whereas in lump sum it outperforms if timed well. This is the key. If you are not timing well, then you might not get good returns. Emotional comfort in SIP is less stressful, easier entry. Lump sum, you will have a harder time to enter confidently. Now let's see when to use SIP. Ideal scenarios for SIP. If you are having monthly income and you don't have surplus each month, then you can go for SIP. If you want to avoid market timing and stress, go with SIP. Long term goals, building investment habit for retirement or future needs. Beginners, new to invest and want disciplined approach. In these scenarios, it's better to go with SIP. SIP provides rupee cost averaging and reduce volatility impact over time. When to use lump sum? Ideal scenarios for lump sum. If you have sudden surplus like bonus, sale proceeds, inheritance, or windfall gains, then you can go with lump sum. Quick deployment. Want immediate capital deployment without waiting. Market confidence. Confident about current market valuations and entry point. Experience. Experienced investors who understand market cycles. So I am advising only if you have market confidence and experience, only then go with lump sum. Otherwise, go with SIP. There is other method like STP, systematic transfer plan, to reduce entry timing risk with lump sum. See, now let us see real example uh, difference between SIP lump sum and lump sum via STP. See, here we are assuming 12% annual returns. This is not guaranteed, but usually this is a return market gives when you are using good approach. Say monthly you are investing 5 lakhs and invested amount is 3 lakh. Final amount will be 3.9 lakh in SIP. Whereas in lump sum you are investing all the 3 lakhs in the beginning. So final amount will be 5.9 3 lakh. Lump sum IST. Here initial amount is 3 lakh, but this 3 lakh you are keeping it in liquid fund. Here we assume 6 to 7% return. And monthly you are transferring, see in 12 months you are transferring it to mutual fund. Then your final return will be 4.8 to 5 lakh. Lump sum will win in bull markets, but STP reduces the risk. So if you are unaware of the market cycles, then go with lump sum via STP. Now let's see taxation rules. Equity funds, uh, you need to pay short-term capital gains if you are redempting within 1 year. Here it is 15%. Long-term capital gain is 12.5%. If it is beyond 1.25 lakh gain. Whereas for debt fund, if it is less than 3 years, you need to pay as per slab. If it is greater than 3 years, you need to pay 20% tax. Now let's see some practical questions. People think CP is risk-free, but it is not. It just reduces volatility, doesn't eliminate complete risk. Market risk remains. Emergency buffer. Never invest your entire surplus. Keep 6 months emergency fund. Don't stop during crashes. SIPs work best during market downturns. Buy more units cheaper. See, this is one of the mistakes people commit regularly. When market is falling, they stop the SIP. That is not correct approach. Here you are getting stocks for lower price, so you need to continue. Also, here nomination is not legal here. Nominee is just custodian. So use will if you want to avoid further conflicts. Use STP for lump sum instead of SIP. This reduces entry timing risk significantly. Senior citizens lump sum safer in debt-oriented funds for stability. Safety alert. Use SEBI-registered platforms only. Report fraud via 1930. Also, never take investment advice from unregistered persons or entities. Now, let's see summary for smart investing. Key recommendations. For new investors, start with SIP for habit formation and you will have rupee cost averaging benefits here. If you are having one-time surplus, use lump sum with STP strategy to reduce market timing risk. Smart investing formula is like you need to have right method, right fund, right duration, then you will have financial success. Remember both methods work. Choose best on your situation. Start investing today with proper planning. Thank you.